Interchange Plus is the least expensive, most transparent form of credit card processing pricing. Then until recently, it was only available to businesses with large processing volumes. In this video, I'm going to talk about the differences and the benefits of Interchange Plus compared to the more common bundled pricing model. In order to fully appreciate this video, you should have a general idea of what interchange is and how it works. Let's examine bundled pricing first. As you'll soon see, bundled pricing plays a big role in the stigma surrounding credit card processing. On a bundled pricing model, a processor quotes you three rates called qualified, mid-qualified, and non-qualified, with the qualified rate being the lowest and the non-qualified rate being the highest. For example, a typical bundled price quote for a retail business would look something like 1.69% qualified, 2.5% mid-qualified, and 3.25% non-qualified, each with a 25-cent transaction fee. Now think of each rate category as a container or a bucket, and I'll illustrate how bundled pricing works. With bundled pricing, the processor essentially sits between the wholesale cost of interchange and your business, dictating into which bucket individual interchange fees are routed. For example, Visa's current interchange rate for a swiped rewards credit card is 1.65% plus 10 cents. If the processor sends the swipe rewards credit card to your qualified bucket, they'll make a gross profit of 0.05% plus 15 cents. If they send these transactions to your mid-qualified bucket, they'll make a gross profit of 0.85% plus 15 cents. And if they send these transactions to your non-qualified bucket, they'll make a gross profit of 1.6% plus 15 cents. By grouping or bundling various interchange rates into the bucket of their choice, processors effectively keep you in the dark about the actual cost of a transaction, and they don't have to tell you how they're qualifying interchange. This allows them to inflate their markup behind the scenes by sending the majority of interchange fees to their mid or non-qualified buckets. As you can see, processors can generate significantly more profit by changing the bucket to which they route interchange rates. And this example uses only a single interchange rate. Compound this over 10 or 15 different rates, and the cost increase to you is that much more significant. To complicate matters further, bundled pricing makes it virtually impossible to compare quotes from different processors. As we've just realized, you can't take the bundled pricing at face value because processors can manipulate costs behind the scenes. For example, let's say two processors offer you a bundled price quote using the exact same rates from our example. But processor A routes rewards interchange rate to the qualified bucket when processor B routes it to the non-qualified bucket. We know from our example that processor A is offering a much better deal, but this wouldn't be apparent unless you knew how each processor was qualifying interchange. The industry term for not being able to accurately compare bundled pricing between different processors is called inconsistent buckets. Not knowing how interchange is being qualified and paying an inconsistent markup isn't even the worst part about bundled pricing. Two more potentially devastating factors take precedence. When you issue a customer a refund, you're supposed to get back a portion of the interchange fee that you paid on the original transaction. But because interchange is generalized on a bundled pricing model, it's not possible to issue interchange credits. In the case of businesses that issue hundreds or even thousands of refunds a year, this represents a huge loss of revenue. For example, Visa's interchange credit voucher rate for consumer retail credit cards is 1.76%. Losing out on this interchange credit over $50,000 in refunds would cost the business about $880. Compound this loss over months or even years, and the unnecessary loss of revenue can really add up. Another nail in the coffin of bundled pricing is the inability to optimize interchange. Interchange charges account for roughly 70 to 75% of total processing expense. The process of reviewing interchange rates and modifying your processing behavior to get the greatest number of transactions to qualify for the lowest rates is called interchange optimization. However, on a bundled pricing model, you can't see interchange detail on your statements. You can only see the processor's qualified, mid-qualified, and non-qualified rates. The inability to optimize interchange and spot potential problems can be even more expensive than the inconsistent markup and the non-receipt of refunds combined. So let's recap the weaknesses of bundled pricing before we talk about Interchange Plus. Bundled pricing results in an inconsistent markup from one interchange rate to the next. It hides the true cost of processing. It doesn't allow you to see interchange detail. It makes it impossible for you to optimize interchange charges, which are the largest portion of expense, and it makes it impossible for you to receive interchange credits, a potentially huge loss of revenue. And finally, it allows the processor to increase their rates on your account without having to change the rates that you see. Now that we've got the mess of bundled pricing out of the way, let's take a look at Interchange Plus. On Interchange Plus, a processor quotes you a single markup over interchange. For example, a typical Interchange Plus quote would look something like 0.25% plus 10 cents. There are no buckets with Interchange Plus, and the processor isn't able to manipulate their profit based on interchange rates. Instead, interchange rates are passed directly to you, and the processor's markup is added to the actual cost of the transaction. In keeping with our example for bundled pricing, let's follow an Interchange Plus transaction using Visa's Retail Rewards interchange rate of 1.65% plus 10 cents. Since the processor's markup is separate from actual interchange, their gross profit on every transaction remains exactly the same regardless of the interchange rate. As you can see, their profit over interchange is exactly the same as what you were quoted. There's no guesswork with Interchange Plus. I think the benefits of Interchange Plus are pretty clear, but let's recap just in case. With Interchange Plus, your markup is consistent regardless of the underlying interchange rate. You're able to see the true cost of processing, and your processor can't increase costs without you knowing it. You're given credit on interchange fees when you issue a refund, and finally, you're able to see interchange detail in your statements, making it possible to optimize interchange charges. Getting Interchange Plus is a big step towards saving on credit card processing fees, but it's not a golden bullet. Keep in mind that Interchange Plus and bundled pricing only account for a processor's markup over interchange. Other factors like monthly, annual, and miscellaneous fees can really add up.